Hey, I'm Dan Brisse, real estate investor managing over $430 million in client assets. And today I want to talk to you guys about something that Wall Street is absolutely obsessed about. Kevin Warsh's strategy for the Federal Reserve. This is interesting because if he gets confirmed, it could completely change what happens next with interest rates and mortgages and the bond market, which is a big deal. And here's the key. Warsh is pushing a very unusual policy mix. It's basically a strategy that pulls the economy in two different directions at the exact same time. Warsh believes that the Fed's balance sheet is bloated. So right now, the Fed holds about 6.6 trillion in assets, and he argues that that's not neutral. His argument is that when the Fed owns that much, it distorts markets and it changes pricing, and it creates this artificial demand for mortgages and bonds. So his idea is this: step one, shrink the Fed's balance sheet aggressively. And that's called quantitative tightening, or QT. We saw QE, quantitative easing. The opposite is QT. Then he's gonna cut short-term rates. His belief is that if the Fed proves it's serious about shrinking its footprint, by doing that, it earns the ability to cut the Fed funds rate without looking reckless. So what he wants to do is, simple version, with the Fed's fund rate, Warsh wants to lower it because he believes that it helps households, small businesses, and the real economy, or Main Street. And for the long end of the rates, say the 10-year and the 30-year, Warsh wants the Fed to stop being a major buyer of those bonds. He wants bond pricing power to go back to private investors or real demand and real supply. And this brings us to the mortgage rate problem, which is the controversial part, because here's where this gets messy. A lot of politicians, they want lower mortgage rates, but Warsh's strategy could actually make mortgage rates go up in the very near term. And here's why. Mortgage rates are tied much more closely to the 10-year Treasury and the MBS market, not the Fed funds rate. So even if Warsh cuts short-term rates, if the long-term yields rise, mortgage rates can stay high or even get worse. Then you've got the MBS issue. That's the part nobody's talking about right now. So right now the Fed owns about 2 trillion in mortgage-backed securities. That's MBS. That's a massive amount. And Warsh is aligned with the Fed that the Fed should unwind the position faster, potentially through faster runoff or outright sales. If the Fed starts dumping MBS back into the market, that means more supply hits private investors. And when supply increases, prices go down, yields go up, and mortgage rates usually follow up. So the uncomfortable truth is that Warsh might cut rates, but still make mortgages more expensive in the near term. And that's why economists and macro firms are warning that this could directly clash with lower rates. That's the political message. This idea created a bond market reaction, and that's already happening right now. The bond market has already started reacting, and the move has a name. It's called bear steepening. And simply put, that's when short-term yields start falling because traders expect rate cuts. But long-term yields, they rise because investors demand more yield for holding the long-term debt. And in plain English, markets are saying, okay, maybe we're gonna get rate cuts, but we're gonna charge you more to borrow long term. Here's another major shift for less Fed hand-holding. Warsh is also a critic of the Fed's style of guiding markets. He does not like the dot plot. He does not like how the Fed's basically promising what they're gonna do in the future. So if Warsh takes over, bond traders expect less forward guidance, more uncertainty, more volatility, and bigger swings in rates. And that matters because volatility pushes investors to demand something called term premium. And term premium is just extra yield or extra return investors require to hold these long-term bonds because they don't trust that the Fed is going to step in and stabilize the market if things break. So in summary, if Warsh is running the Fed, this is what markets expect short-term rates to be like. Main Street long-term yields likely higher because the Fed stops supporting the long ends of the market. Mortgage rates, more volatility, and potentially higher because MBS supply sales, they can offset rate cuts. So what to watch for next? And this is the big catalyst. The biggest test will be his Senator confirmation hearing. Right now, there's still a procedure delay because Senator Tillis, he has a hold on the place. And when Warsh finally testifies, markets will be watching one thing above everything else. Does he double down on unwinding MBS aggressively, or does he soften that stance to align with the push for lower mortgage rates? Because if he doubles down, the mortgage markets could get very uncomfortable very fast.